are super excited to be here with you today. We're going to talk to you about I don't know if it's a super secret strategy, but it's definitely a supercharged strategy on saving money on your taxes if you're a W-2 high income earner. My name is Chris Schwartz. This is Nicole Faulkner. She is one of our newest agents on the White Whale Real Estate team, and she is your tax strategy saving extraordinaire pro. So thanks for being with us today and explaining to us how to make this possible.
Awesome. Thanks, Chris.
So before we get started on that, can you tell us a little bit about your background and why we're trusting you on our tax saving real estate strategies?
Absolutely. So super excited to be here with you guys today. I spent the last 18 years of my career as an executive in an IT consulting firm. So my husband and I are both W-2 earners that we worked hard, played hard, but we didn't necessarily think through different investment strategies at the time that could help us kind of set ourselves up for, diversification of assets, how do you save taxes, and honestly, April was always usually really tough. I mean, we were, claiming zero. We would put away, we'd either be penalized for not doing quarterly estimated payments, or we'd really owe a big chunk of our savings come tax time. And that was just really tough. So we wanted to think about how could we do this differently? And through some colleagues, I learned of a strategy where there are opportunities to invest in real estate and be eligible even as a W-2 earner to basically help reduce your tax liability. So spend some time understanding what they did. I went and learned through a masterminds and kind of mentoring course, what are the different tax strategies you could take advantage of to reduce your tax liability, and went for it. We purchased...
Big point right there. You went for it. Good for you. So many people just study and go course after course and they don't do anything. Yes. So good for you.
So last year we bought our short-term rental up in Daytona, doing well, and it really helped us save. So we didn't have to write a big out-of-pocket check this past April. And it was all due to this tax saving strategy that we're going to be talking about today.
Awesome. Sounds good. So Nicole is not only done it, she's come from the W-2 side, so she feels your pain out there. And,
very much so.
And I feel like that's something that people they feel like they just get caught in the trap of you're working hard, you're doing your things, you're doing exactly what you were told to do when you grow up, and then now April here comes, you're getting penalized by not paying the taxes quarterly or because you're making too much money.
Yeah.
And then the worst part about that is you're having to pay out of your savings into taxes. So I know I'm at least really excited to hear about these strategies that are out there. I feel a lot of people in the W-2 world feel stuck on not being able to write certain things off. So when you said you just went for it, what were some of the objections, or like when you talked to your accountant, I feel like a lot of people are going to say our accountant says we can't do that, or there's no way this will work, or I can never, or you don't understand my W-2. I think you probably had those same reservations.
Those were always the conversations we had anytime we met with a tax professional is, okay, with the new standard deduction, not a lot of things qualify. You can't use income from, investments and losses there because that's passive and your W-2 income is active. So they're in different buckets, there's walls. Those are some of the objections you hear. What you hear about real estate professional status, it is very hard to achieve if you are going to be working full-time as a W-2 employee. There are restrictions on like 750 hours that you need to do in material participation. So it doesn't make itself easy to those that do want to stay in a full-time 1099 or W-2. There's also restrictions on how much money you can make. That said, there are ways, one specific way, not through long-term rental activities, but through what was introduced to the Tax Cuts and Jobs Act of 2017 around short-term rentals. When I say short-term rentals, think Airbnb, Vrbo.
Okay.
That's kind of what you'll hear in the industry people talk about. But really what it is a rental property that has people staying on average 7 days or less.
So it doesn't have to be the 1 to 2 nights. It could be 7 or less on average.
You could have someone say 10 and then other people stay less, but on average, you're going to need to have 7 days or less as your average guest stay. And really, what that does is it puts a little bit more onus on you, so it no longer is a passive activity, it is an active activity. So therefore, for your short-term rental, all of the income and all the expenses can now play in that same bucket as your W-2 income and expenses, and really, really help you with a number of tax benefits, your interest, all these other things that you're able to kind of leverage to write off and reduce that tax liability.
And so just to kind of like very oversimplify this, you're talking about active and passive income assets essentially. So with you doing the short-term rental, you are actively being the one that is managing and being there and making things essentially function and happen on a day-to-day. So that's kind of, again, very oversimplified. Am I correct in saying that?
Yeah.
I'm looking at it as you are actively doing it. That's why it can be classified as an active advantage for your W-2 offset there.
So there's a couple. So yes, the 7 days or less is just one of the conditions for you to be eligible for the short-term rental exception. You also need to have it be purchased new to you. So mom and dad, sorry.
I was gonna say.
No sister, brother, no one in your direct line. And you can't have also lived in the property. It truly has to be an investment property. So that's kind of one big criteria.
So new to you, number one.
New to you. Second one is sweat equity.
Right.
You will need to materially participate. And there's like 4 or 5 different ways that the IRS has in the code outlined what they consider material participation. It's a little different for real estate professionals. Honestly, if you are going to try and classify for it, you're likely doing a large portion of the work. If you start introducing property managers and other things, you're going to have to make sure you prove that you work more than anybody else.
So when you start doing that, now we're getting into the passive bucket. So this strategy really only like to make sure is for somebody that's going to be actively doing it themselves,
Managing
like
it.
you guys. So like you and your husband, you've got one, you're managing one, and you're the grand poobah of the whole deal right now.
I'm coordinating all the contractors. I'm doing a lot of the legwork in there to keep it up. I'm communicating with all the guests. I'm doing all of that.
Okay.
So it gives me the number of hours I need and also makes me the primary person doing all of the work.
Perfect.
So that's another big one as well. I can't stress enough books and records, making sure that you are taking every hour that you're spending on there and categorizing it appropriately. So we're seeing some things with the IRS of like travel time. Is it included? Is it not? So you get really, really specific around the activities and how much time you've spent, and you have those good books and records. So if anyone does come knocking, you can show that you materially participated.
Now with that, so I'm sure there is a tremendous amount of resources out there for apps and software to be able to use. So there's really no excuse on why you shouldn't be able to easily log all the things you're doing. Is that correct, or am I way off base there?
Yes. So the good news is, as setting all of those things up, pricing tools, scheduling, property management systems, automated messaging, that's all active participation in that. So your first one, you are going to spend a little bit of extra time just to get all that to go. But yeah, then it gets to be a point where, year 2, things like that, or as you're bringing on new properties, there's a little less setup time from that perspective, and you're really focusing on guest communication, managing any kind of upkeep and whatnot.
Perfect. So it sounds like you've got, once you set up the system, then it's kind of plug and play for the other properties you bring in.
Yes, and we can probably do a whole other topic on what those tech stacks look like, what are best practices, how do you kind of accelerate your STR.
So that was going to be one of my main questions is you're a high income W-2 earner, your spouse is as well, you guys are busy, you don't have time to barely say hi to each other during the week, but now you've got to manage a property. So it sounds like once you get the system set up that it does become relatively automated and systematic in a way?
Yes, I mean, barring the nightmare guest that throws the unapproved party and things like that, you definitely want to make the time to carve out and make sure, it's, an hour and a half a day or like a long weekend. Like you're planning on doing some weekends here and doing some things so you can get your hours. And you're going to need to do that anyway to get it ready for it to be the guest experience you want to provide to those guests. So it does take time. You need to be willing. You're not just a passive, here's some money and go run it. That's not what this strategy is for. But if you have the time, you can get a lot of benefit out of it. We've talked a little bit about, just putting it in that bucket of active. But the real kicker, not just having that asset for ongoing, is what we're calling super tax strategy through bonus depreciation.
All right, perfect. A little da-da!
Okay, so first, let me just probably start with depreciation for those maybe who aren't as familiar with it. Depreciation is basically taking the useful life of an asset, like a rental property, and accounting for kind of loss of value for wear and tear, age, things of that nature. You might, your home, you might hear 27 and a half years is the useful life that, 1/27th and a half of the value is going to be taken out every year. With this strategy, since I mentioned...
And that 27 and a half, that's just a standard IRS.
IRS.
Again, generalization
Yep.
here. Let's just give you guys an idea of what's going on out here. But this is where we got that 27 and a half number. And,
Yep.
and another number soon to come, I believe.
Yes. So if we were just going to be doing a long term, you'd be using that number. Because we've now reclassified ourselves as a short-term rental, which is more like a hotel or a commercial, the next number we're going to talk about is 39. So the depreciation schedule, or that useful life for our short-term rental property, is 39 years. So you could take 1/39th of the value of that purchase price as an expense loss every year. Sounds great, right?
Sounds good. I'm intrigued.
Okay. Yeah.
Sounds like I might be saving some money here.
But what really is interesting is in 2017, with the Tax Cuts and Jobs Act, they again allowed for bonus depreciation to not just new developments and whatnot, but new to you properties in the short-term rental market. So what we do is basically I purchased a condo and then I went and got what's called a cost segregation study. And this is a report that you can work with your CPA and some other teams that basically takes your purchase price minus the land value. We already talked about land doesn't devalue. So you're left with the remainder of the structure and the contents of that structure that can be kind of depreciated over time. But we all know that there's things inside of the structure or the building that aren't going to last those 39 years. Think your flooring, your appliances,
my blinds, my window treatments are going to last 39 years.
That's special to Chris.
My time capsule.
But this report, this cost segregation report, will actually put line items of 5-year property items and 15-year property items separate from the structure or the building itself. And we can use these items to do a one-time phantom loss through bonus depreciation on our tax return against our active income using this strategy. Let's take an example. So we have Joe, our W-2 engineer who, wants to get into this strategy. High earner, $250,000 a year. He found a property that he likes that he wants to put in as a short-term rental for $500,000. So when he purchases this, he looks at it and says, on the property appraisers account, it says, okay, land's worth $75,000. So what we're looking at, Joe now has a property that's got $425,000 that he could depreciate over this 39-year window as a loss each year in his taxes. Great. But what Joe did is he went and he got a cost segregation study and found that, roughly 10 to 15% of the items were in the 5-year bucket, and another 5% were in the 15-year bucket. So now he's adding these two numbers up. That's $85,000 of the bonus depreciation amount that he could technically take as a write-off in the year that he puts it in service.
Awesome.
Which is a huge difference than 139.
Big deal. Exactly. So and that's where that bonus comes in, is doing that cost segregation study, is being able to do that and get that extra little bit of depreciation there to offset what your W-2 active income earnings are. So could you give an example, just rough numbers on, like, if he's making $250 a year and like what he would, what that would look like?
I'm going to have to break a few hearts.
Putting you on the spot.
Yeah, I'm going to have to break a few hearts around the schedule of what this legislation is doing, but we're going to pretend just for a moment that we're somewhere in the years between 2017 and 2022. And
sounds good.
So when they're 100% eligible for bonus depreciation. So if he was making $250,000, and let's say his rental brings in $60,000 for the course of the year, now he's going to go in and he's going to take the mortgage insurance, or the mortgage interest. He's going to take property taxes out. He's going to take the standard depreciation, that 10,000-ish number out. And then he's also going to take out this bonus depreciation of $85,000. So he made $250 from his day
W-2,
job,
right?
$60 from his rental income. He's going to remove $141,000 of expenses just in this area. So now we're looking at the income that we get to go then play around with all the different other expenses and credits and whatnot. But now instead of $250 with no property, he's looking at $169,000.
Wow, that's incredible.
Different tax bracket, a lot of benefits just opened up from this strategy, and not necessarily, having
a one-time deal. So, and definitely something to consider too is that this is allowing you to possibly enter a whole nother tax bracket as well, which, like to your point, is going to open up a lot of different other opportunities and strategies that you could implement.
Yep.
Now
Other things that are at ordinary income interest, now it's at a different percentage. So you're saving money all over the place from that perspective, just by leveraging this strategy.
And you have another piece of real estate that you own.
Yes.
So it's like a win all the way around.
Yes,
So,
yes.
So a lot of stuff here, a lot of numbers here. Hope you guys are following along. If not, this again is just a taste. Nicole is your tax strategy specialist. She'll help you out, get you pointed in the right direction. So before we go though, this sounds great. A lot of things, a lot of benefits here. I'm still coming back to it. Sounds a little complicated. What's been your personal experience from when you decided, let's go do this? And would you recommend a condo or a single family home?
Yeah. So the one thing I didn't get to mention, I said 2022 for a reason. This is great. It has a schedule where it's phasing out. Right now, this year is 60%. So up until 2022, it was 100% of that $85,000 number. Last year was 80%. That's the year that I did it. So it does take some percentages off. This year's 60, next year's 40, following year's 20.
So get in while you can.
2027, it's gone. So
Okay.
Don't wait. There is some legislation that's being considered now that will actually return it back up to 100%. All of us have our fingers and toes crossed, but
We've also been fingers crossed that interest rates are going down for the last year and a half too. So
60% is still not a bad little bucket. I mean, at 60%,
absolutely.
let's see. Joe over here got $51,000 as a one-time.
All right, I wouldn't be mad. Nothing to be mad about there.
And still making 60 grand off of the income coming in. So
yeah, it's
kind of pays
still,
for itself.
still a win to me, right? For sure.
Who's this also not for? Couple things. So fix and flippers.
Okay.
You probably want to take a look at the numbers and avoid this because you will end up having bonus depreciation recapture. Unless you want to keep it for a certain amount of time, it's going to basically come back in and you're going to owe the money. So again, we'll work with tax professionals on this, but that's usually a hard one to pull this off with. Ironically, I use this strategy for a condo, just given the circumstance of where I was last year. But that's a tough one too. You have to look at the numbers. It typically has, I have a condo on Daytona Beach, land value, really high. So even though the purchase price was great, the land value being so high gave me much less of a depreciation basis to work from. And there's not a lot of interior or contents.
Right, okay.
So, I was still, don't get me wrong, still loved it, but it wasn't as much bang for a buck as if I'd gotten a single family residential home.
But being your first one though, I mean, at least you got up to bat, took a swing, you're going through the process.
Yep.
And I think this is something that one of those things that you just kind of have to learn by experience, School of Hard Knocks, that now you don't have to because Nicole has shared it with you. But it sounds like still overall though, a good option.
Good investment. I mean, I took into effect the HOA, some other things. Again, books and records, people, got to make sure that you go in with the eyes wide open and do some modeling and forecasting, depending on your investor strategy. Maybe you don't care. It's a personal thing. You want to have that property there so you don't need as much cash flow. But you can't go negative in your cash flow. So you just need to think through some of those things to make sure it makes sense for you and for your investment style.
Perfect. So last question I have is when can or should somebody start this process? Do they have to notify their accountant first, or what does that look like for them to get going? Should they wait until 2025 to start, or can they start now in 2024? Loaded question, I feel like.
I would want to say now because 2024 is 60%, next year's 40%.
Okay.
So same property, you now are depleting what you can and can't recover from.
Sure.
It's all about finding the right property. Another big thing is to make sure that you're able to operate the property that you find as a short-term rental. New Smyrna has some guidelines around, where are you able to have a place that allows 7 nights or less stays.
Okay.
So it's really about finding that right property that meets the right legislation, and the earlier you do it, the more time you have to get those participation hours in.
Sure.
Without having to rush through it and kind of be in that bucket of trying to meet all the requirements so that you can claim it on this year's taxes.
Perfect. Okay. So real quick and recap and hold me accountable here. So the conditions that you'll need to follow in order to take advantage of this supercharged tax saving strategy is, number one, it has to be
New to you.
New to you. So like you said, you can't be inherited. It's got to be new to you. The second one is
Spending time on it.
material owner. How do you call it? Material
Participation.
Material participation. So you've actually got to be the one doing it. And the third, I'm going to say it's got to be a short-term rental, STR, short-term rental. So we're not doing this for long-term rentals.
Has to be 7 days or less on average.
7 days and 7 days or less on average.
For the year.
So there's your top three right there. So little thing, little conditions, little big conditions.
Big conditions.
Big conditions. So check with Nicole, check with your tax advisor, and whatever Nicole can do for you, we'll leave her information below. Let us know what you'd like to hear more of. We'll have her reach out to you directly, and we look forward to seeing you guys in next week's video.
Awesome. Thanks, Chris.
You're welcome.